Well, this is less about the high memory prices and more just simple numbers about where the guidance is going. So Scott, just to take a step back, they guided at 12, or the street was at 12% revenue growth through September. They guided to 9 to 11. Now, when you find this subtraction key with a company, a stock that's been up 22% over the past month versus the NASDAQ up 1%, when analysts go to that subtraction key, that is negative for the stock. There's just no explanation that can get investors comfortable. And I think that's kind of where the conversation ended. But I want to go through that a little bit and answer your question about like what's the substance of what's going on? Is this about memory costs? The answer is a little bit about memory costs. Maybe if you think about the 10% decline, probably 1 or 2% is about just higher memory costs. It's going to have a 50 bips negative impact on their margins in the September quarter. The bigger picture is on revenue. And effectively what happened, this is a pretty unique dynamic, but it makes a ton of sense, is that the iPhone has been on fire. It was up 22% in the June quarter. If you look at over the past year, it's been up 22%. That compares to over the past 5 years, it's up 3% on average. So we've got this huge surge in iPhone demand, and separately the Mac up almost 30%. Typically it's up a few percent. And what that means is that they have essentially been pulling through inventory. Remember how tight inventory is? In part because of these pricing deals that they have to try to keep costs low. They're limited to the amount of capacity that they've had. So they pulled inventory essentially from September into the June quarter. And that means they just simply don't have as much. And the way that I'm going to back test this, and it'd be pretty easy for your listeners to do this, is just look at what the lead times on the products are. Right now, they're running a few weeks. Now, that typically would be same day on many of their products. And that's an indication that they are, in fact, constrained. And so effectively what happened is they stole demand from the September quarter and pulled it into the June quarter. There's still a ton of demand out there, stole supply, and pulled it into the June quarter. There's still ample demand. And I think at the end of the day, just to put it in the most basic terms, Street was at 12% revenue growth for September. If they would have kind of had currency constant and supply constant, I bet they would have guided to better than 15% growth for the September quarter.
So, Gene, you were busy this week, as a lot of tech investors were, with all the earnings, but I got to ask you about this story. Wall Street Journal story about Tesla spinning out its China business to maybe pave the way for a SpaceX merger. Does that seem reasonable to you?
Yeah, I would say it's reasonable. And it is going to increase the probability that I have put on this happening in the next few years from 90 to probably 92%. Okay. About a week ago, I had it at 80%. And then the Tesla earnings call, they let a question in about the two companies coming together, which surprised me. Elon started to answer the question, and then legal took over and said, really, we can't say much. And then Elon grabbed the mic back and started to kind of pontificate about the benefits of these two companies being together. That took me from 80 to 90. Now I'm at 92. And the answer is, it just makes a ton of sense. Like this China piece, I think, is grossly underappreciated about the tensions from the technology companies geopolitically, as I've been meeting with many companies that have ties and these leading private companies that have ties to China. It's pretty clear that they want as much separation as possible. And so my view is that we're probably a couple years away. Elon's has always structured the China business to be easily separated from the US business for a lot of reasons. And one of them is his master plan. It's very simple. He's going to just keep rolling up his businesses into a master company. And so to answer your question, Paul, is I think that this, it makes a ton of sense. And even though they're saying it's not going on, I think it very much is in the cards.
Sounds like it'd be good for Elon Musk from the way he operates and runs his company. Would it be good for investors?
Now that's the key question, and I think the answer is that the simple answer is yes, from two levels. On an operational piece, which is most important, is that when you bring things together, you reduce redundancies. And there's this long-standing view within tech companies that are highly innovative that smaller teams are more effective. And so when you have smaller, tighter teams and effectively you can do that, I think that's one piece of bringing all these together. I think their visions are very similar, obviously around being AI first, space AI with SpaceX, physical AI, terrestrial with Tesla, all of that makes sense. The other reason why I think investors will be rewarded is that the dynamic around Tesla and SpaceX to a lesser extent right now is really about investor confidence around the long term, retail investor confidence. And I think that that unwavering confidence would only increase if they brought some of these together. And that has really explained how Tesla can still be a $1.2 trillion company despite having many of its targets pushed back for years. And so I think you put these two together, it would undoubtedly be the biggest company. I think you put them together, I think the path to a $10 trillion company is well laid at that point.